Thanks, Emily. I think I'm going to kick off our presentation this afternoon with just a little bit of information as it relates to all of the information we've been giving you in these webinars, and it goes right along with the information we're going to give you today. And that's just a reminder that the guidance is constantly changing. We don't have anything final yet. The information that we're going to go over today is current as of right now. So we are providing you with the most recent information. However, the reality is there are going to be changes coming soon. There is a bill that is actually set to go to the House, I believe, next week, it sounds like, that is specific to the Paycheck Protection Program only. And that bill is looking to create some additional flexibility with the use of funds. So extending the 8-week period, potentially changing the repayment terms, changing the 75-25 rules so that you have a little more flexibility to use these funds for more than 25% of overhead costs. But I'll state it again, the guidance that we have right now is what we're going to give you. So what I just mentioned has not passed yet. We do expect that it likely will. It's not going to be for a couple of weeks. So for right now, we want to be able to give you the best guidance that we have and start playing around with the forgiveness application. It is not due right now. There's a buzz date of 6/30/2020. So just as a reminder, don't rush to get all these calculations done and stress yourself out over the holiday weekend, because the reality is there are likely going to be changes and you have time. The application won't need to be submitted for at least another 6 or so. So we just want to make sure that we're answering questions as best we can and giving you the guidance as it happens. I did just sit on a webcast literally from 2 to 3 Central today, so right before this, with the AICPA, which is our governing board as a CPA firm, and they mentioned that they expect another 20 to 25 frequently asked questions to come out by tomorrow, and in addition to some new interim final rulings. So literally, it could be posted right now as we're presenting, which wouldn't be the first time that news has come out while we're presenting. So it literally has happened before. So we just want to make sure that everybody is aware that we're giving you the best guidance we can as it stands right now, but beware that there will be some additional changes. So this is really just to keep you up to date, keep you informed, and give you some tools to be able to start thinking about what forgiveness could look like.
Great, thank you, Kate. I want to start off by getting a feel for what everybody knows so far about the forgiveness piece. So Emily, would you please put up the first poll? I'm basically just asking here if you've read through the application, either you're an expert at it and you can join us on the panel, or maybe you've done an overview, or you haven't looked at it, or you haven't even received it. I would love your feedback on that, and then we will move forward when Emily tells us that we're ready.
Just a few more seconds for you guys to get your vote in. Go.
Awesome. Okay. So the majority have either no exposure or limited. So that helps a lot in focusing our discussion. So we'll go ahead and get started. And as Kate said, this is subject to change. What was clarified in the application are a couple of things. It's clear now what the expectation is for calculating FTEs, and we'll talk about that. They have addressed the AICPA's question earlier about payroll and have made it more clear of what that 8 weeks entails, and we'll go into that. They've also clarified with the wage issue that it's pay rate versus total pay, and again, we'll go back to that. While it's great to have a few things clarified further, there's still so much, like Kate said, that isn't. And there is a potential extension. There's also some special groups that have not necessarily yet been addressed, and maybe. I know for some of you that are on this particular webinar, if you have the teacher situation where you pay them over the whole year, that has not been addressed specifically. And I have not heard personally a consensus on that and how to treat that. So just stay tuned, and hopefully that will be one of the things addressed here in the very near future. So starting off with the application, this is just an overview of what's included. First, I want to tell and remind everybody that this is for all loan recipients. The $2 million you've heard thrown around out there is about that eligibility piece when you sign the application for the loan, that the SBA is not going to look for eligibility issues for anybody under $2 million. But everybody who received PPP funding is required to do this forgiveness application. So this is for everybody, not just those in the higher group. The other thing to note is that while recipients of less than $2 million will not be subject to SBA criteria looking at eligibility for the loan, you could still be selected to have your application reviewed, because these are going to be submitted to the lender and reviewed by the SBA. So there can still be some questions, and that's why, again, we emphasize, as we have before, the importance of documentation and making sure you have everything in place. So the application is 11 pages, and we'll look at that back and forth with some examples as we go through. But first off, I want to start with defining this covered period. There's been a lot of confusion over this as well. And the first alternative is what's been fairly consistently stated, that the 8-week period starts the date the funds are received. So the date the funds went into your bank account. Now, in this application, they've added a new item, which is the alternative payroll covered period. Note that this is only for employers who have weekly or bi-weekly payroll. It does not apply if you're bi-monthly or monthly payroll. So that's an important distinction, and it's your choice whether or not you want to use the alternative period. I'm going to flip over here to the actual application and point out a couple of things. So you'll notice, like I said, it's an 11-page doc. For those of us who are not tax experts like Kate, I look at this and I freak out and it goes a little bit backwards to the way my brain works. So that's how we're going to address it as we go forward. You basically start, if you look here at the application form itself, you'll notice that when we get down to the payroll and non-payroll costs, it right away refers you to a schedule. So basically what you're going to see is we start at the back and move to the front. But in relationship to this covered period, I did want to highlight one thing to start off here, that sorry, I thought I had it right in front of me, and I've gone too far. I wanted to go backwards, that's why, sorry. Apologize for the confusion on my part. Here on the instructions for the application itself, you'll see eligible payroll costs, and it makes it very clear, and it's mentioned a number of times throughout this, that they want a 56-day period. And you'll also note that it says right here, for payroll costs paid and incurred during the 8-week period, and that you can actually pay the final payroll after the covered period. Now, it's hard to understand sometimes without examples, so let me flip over here to an example. Hopefully this is, you can see most of this on the screen. This will be part of what gets sent out after the fact. What I've done here is for, let's say, a loan that is received on April 20th, that's the start of the 8-week period. The covered period then would be April 20th to June 14th. I've done 3 scenarios: a weekly payroll, a twice a month, and a monthly payroll, to demonstrate how this works in that section that I was just showing you in the instructions. For the weekly payroll, I did 2 different things: doing it as a covered period, using that 8 weeks, versus electing the alternative covered period. It lays out then the dates that correspond. So the first date you're making a payment after April 20th is here on April 24th, but nothing is eligible because that payroll was all related to an earlier period prior to the start of your 8-week period. The next payroll that's paid on May 5th does have eligible days if you're using the covered period, because the covered period then would include the 20th through the 24th. Now, if you do the alternative period, you can start with the payroll that starts right after the next payroll after the start of your funds. So if you got your funds on April 20th, the next payroll period after that is April 25th. So you'll notice the alternative period starts here. The key thing to note is when you add across here, in both cases, whichever method you choose, it adds up to 56 days. The key point is that with the payroll, it's got to be 56 days, not necessarily months or another equivalent. And you'll see that down here. Under the twice a month scenario, you see that the first part of April is not eligible, even though it's paid on April 22nd. The second payroll, part of it from April 20th to the 30th is eligible, and that includes 11 days of that 56 days. The next 3 payrolls are included totally, except the pay date. You'll notice the pay date here was 6/7. This pay date is after the 6/14 end date. That's where in those instructions it says that you can pay that on the very next payroll date. So that's how that is interpreted in a numerical example. And again, you'll see that this adds up to the 56 covered days of a covered period. In a monthly scenario, you'll see that same thing applies here, that the covered period obviously ends in June, but they've managed to put in all of their 56 days in those periods that are paid there. And that hopefully gives you some example or context around this covered period and the date issue, because that can be a little bit confusing and has been a definite topic of interest.
Melody, can I chime in real quick? There was a good question in the Q&A. Somebody asked, if we choose the alternate payroll period, do we have to consider 2 different 56-day periods, all for payrolls and the 56 days following disbursement of funds for non-payroll costs?
Yes, the alternate period is only for payroll and payroll-related costs, not for any non-payroll costs. So there are 2 periods in that respect.
Thank you.
And okay, Emily, I'm having problems getting back to the whole thing here.
If you just click on slideshow, Melody, and just present the slideshow, I think we should go back.
Oh, there we go. Sorry. Thank you very much.
Very good.
Okay, so hopefully that answered some of that. Now, in terms of doing the actual calculations, like I said, you start at the back and move forward. The Schedule A worksheet, as of the way it's written, does not have to be submitted with the application, but it may be requested by your lender, or there may be a point where you need to have it for documentation regarding the calculations. So just be aware of that. When you look at the Schedule A worksheet, which we'll flip back to in a second, there's 2 tables at the top that you're using to summarize all of your employees. And the primary difference between the 2 tables is that Table 2 applies to those who had pay of more than $100,000 in 2019. Otherwise, the tables are very similar. And you can see how that's shown here and how it plays out. Now, if we go back to the application itself, you'll see I used a brief example here, and I'll show you in Excel where this example came from, but you're putting in your employees and their compensation and average FTE. This is your starting point. In this particular case, there's nobody in table 2 because I didn't have anybody over the 100,000. Now, one thing that I want to emphasize that Kate and I have talked a lot about is this is still subject to change, and you'll see that there are a number of calculations around FTEs as well as the salary reduction. Hold off on doing any of it because 1, it's subject to change, and 2, there's some safe harbors that if you qualify for the safe harbor, you don't even have to go through the calculations. So just be aware of that. So in this example, then, the Schedule A is where we start by putting in that information and the pay information. If I go to my spreadsheet, I can show you a sample of a payroll situation that is being used for this one, okay? Now, the reason I selected this as a potential example is I want to point out that salary does include paid time off. It's both salary and hourly. For those who are church situations or qualify for housing allowance, that was clearly spelled out in one of the supplemental frequently asked questions that housing allowance is included. So all of the items in yellow are included in what we're calling those gross cash wages. These other items, they get thrown around, but they're all part of really going from gross salary down to net. And we're always working on gross salary. So that's the key here. And then in this particular example, we also have the employer items available for the employer paid healthcare coverage and their retirement match. Now, for some of you, it may be in different reporting periods or in different elements, but this one has it all combined. The other thing then is to look at the average hours, because that's how we're filling in those Schedule A worksheets and so forth. Now, you'll notice at the front of the application when we get there, they do ask for total at the beginning and at the end, but I put that here for information. This one, note, there is one person who's furloughed. And because there was not a replacement before June 30th, and the example we're going to do here at least, they did not have a recovery of their FTEs. So we did go through the full FTE calculation. So that's where you'll see when we go back to the application, where these numbers come in, and you'll see that it's at 5.6, and we're going to compare it to the covered period, to the earlier period, the earlier quarter, and see that there is a reduction. So the other thing to note when we're talking about this stuff is you can get really lost in the weeds. This also may not apply, like I said, because of safe harbors, and or if you're 100% payroll, some of the other items that we get lost in terms of what's eligible, you don't have to be concerned with either because it doesn't apply. So if I take you up now to Schedule A, Schedule A will be included in the application to the lender. And you'll notice that this is coming from the worksheet. So we've got the total wages and the FTEs that came from the worksheet. And in this case, the two tables, again, Table 1 and Table 2, and in my example, there was no one over 100,000, so Table 2 did not apply. Then we add in the items that are included in payroll that the employer pays for health insurance, retirement, and state and local taxes. Health insurance is one of those that there's sometimes been questions on. It is not completely defined in the current guidance, but a lot of people believe that dental and eye are reasonable to put in there as health insurance. What has generally been determined is not health insurance is any kind of workers' comp or other kinds of life insurance, because those are not directly health. Those are for life or wage continuance, not insurance related specifically to health. All right, let's go back to the PowerPoint here for a minute. And we're noticing the cash compensation again is what we were just looking at on Schedule A worksheet. It includes the things that are listed here specific from the instructions, except for the thing that is excluded, like we've said all along. This is not new information. Leave that was covered by the Families First Response Act is not included here. The other thing you'll notice is that that $100,000 cap per employee, if you break it out to a weekly, over 8 weeks, that maximum compensation then is the $15,385. So you can't put more than $15,385 in the Schedule A worksheet for anybody, because that's the limit. In terms of other things included in that compensation, there's still a lot of conversations about bonuses, hazard pay, other extras. What has generally been the school of thought around this is that you've got, it should be reasonable and it should be supported. So if you generally do bonuses this time of year and you have a track record and you can document and prove that, then it's potentially eligible. If your bonus is designed more to just get you maximum use of your forgiveness and maximum amount of your loan, it probably is questionable and is not following the intent of what the instructions said or what the rules say. Hazard pay is one of those that makes some rational sense, but again, it's not specifically addressed. So you just want to make sure that you're documenting what you're doing in these regards. Now on Schedule A, we're going to do the FTE, and I said it at the beginning that we finally have a definition of how we're going to do that FTE. It's very clear in the instructions that this is based on hours. And 40 hours or a 1.0 FTE is your max. So if you work 45 or 50, you're still capped at 1 FTE. Now notice too that this is on hours, not on salary. So I know some organizations, especially in the nonprofit world, full-time or salary may be considered 35 hours. That's not a 1 in terms of FTE for this calculation, because it's based on the 35 hours, not the fact that you consider that full-time. And hopefully that makes sense and is clear. Now the salary wage reduction is a whole nother animal and it can be complicated as well. Before we dive into that, I want to see what applicability it has. So Emily, would you please put up the second poll? Did you reduce salary rates or hourly rates for any employees during this time period? This will guide a lot of how much you have to do from here forward.
Just a few more seconds for everybody.
Sure. Awesome. So we are not going to spend a ton of time showing an example here. There'll be some in the handout that you get for those that are interested, but I'm not going to go through it extensively here. The bottom line here is just that it doesn't apply if you haven't had that circumstance where you haven't reduced it by more than 25%. The one thing I'd want to clarify here, like I said at the outset, is what pay rate is. So it's based on the rate, not the number of hours. So for example, if I have an employee who makes $10 an hour and historically has worked 20 hours a week, then their average pay was $200. Now what about in the covered period? What if they're working 10 hours instead, but still at $10 an hour? Well, the wage reduction doesn't apply at all because it's based on the $10 per hour, which didn't change. It may impact your FTE, but it won't change the wage reduction part of this, okay? The other part for those of you who it does apply to is once you do that worksheet, you only have to go forward with the employees that it's applicable to. You don't have to sit and mess with all the employees. It's just looking at those then that would qualify under this potential wage reduction. And there are safe harbors on both the FTE and the wage reduction. So it's good to know that as well so that you may not dive in deep to all of the calculations if you meet the safe harbors. So if we go back to the application itself, we're going to continue here on Schedule A. We've seen the amounts put in the employer portion. What doesn't apply for nonprofits is this compensation to owners line 9. So keep in mind that, again, this was rolled out to entities of various types. So there are some things that are not as applicable to not-for-profits. The other one you'll notice is the demographic information, which is optional on the last page. That is not really geared at this point towards not-for-profits either. So on Schedule A then, I add up all my payroll costs, which includes the compensation, the cash compensation, and those employer paid benefits. Then I look at my full-time equivalent calculation. Now, as you saw in the Schedule A worksheet, we had calculated 5.6 versus the reference period had 6.1. So in this case, there was a reduction. But notice right here, it says right on the application, or enter 1 if the FTE safe harbor is met. So you don't even have to really go through the calculation if you've met the safe harbor, and we'll talk about that here in a second. Now I left the 92% in here as a reduction quotient just for an example. If you did have a wage reduction and no safe harbors that you met. All right. Let's go back to PowerPoint. Your FTEs on Schedule A, those numbers that we were just looking at the bottom, are for your chosen reference period. And I'll show you the options here in a second versus the Schedule A amount. And then that's what determines the reduction, if any, like we just saw on the Schedule A itself. Now here's the FTE kind of calculations. This looks kind of overwhelming, and it should, because if it really truly applies and you have to do it, it is complicated. You notice there's multiple times here that you have to do the FTE calculation. You have to do it for the 8 weeks of the covered period, which goes on that Schedule A, as well as the selected reference period, which we just looked at. You have a choice of 2 reference periods as they're listed here. You can choose which is more advantageous to you. There's also an additional option if you are a seasonal employer. So those are your selected references. Now the bottom 3 items listed here regard the safe harbor. And if you meet some of the requirements, again, you may not have to do this, but just be aware that potentially you're looking at a number of FTE calculations. And one of the things I want to make sure that I point out, and it will be in a slide. Actually, I'll wait for a second because I'll go to the next one and mention it. In addition to the actual safe harbor rule, there's some FTE reduction relief that happens. And this was in direct answer to some of the people saying, well, what if somebody's terminated or leaves, etc. For these 4 situations, if it applies, you can leave the employee that was terminated or left as a 1. You do not have to reduce it to a 0, okay? But it has to meet one of these 4 criteria. Now notice the importance of the first one, that in regards to putting people back to work, it's essential that you make a good faith written offer to rehire that employee. And one of the questions that comes up frequently around this is, well, the employee would rather stay on unemployment because they're making more with the federal kick-in than they would be if they came back to work. If you've given them a good faith written offer, you can still count them as an FTE, and just be aware that they may be violating unemployment then, depending on how they proceed going forward, because the unemployment rules generally state that if you've received an offer for work and chosen not to take it, you may not be eligible for unemployment anymore. So that's an important point for the employee to consider. Employees terminated for cause often also qualify for this relief, and you can still count them as 1. Again, you'd want to document and make sure that you have sufficient documentation for the cause. Voluntary resignations, that's easy, but again, you don't suffer then from that reduction in employee. And if an employee voluntarily requests and receives a reduction of hours, this I've seen most commonly in situations where there's either childcare issues or health issues or other concerns. And you as an employer will not be penalized then, because you're still permitted to count that person at their FTE without the reduction in hours. Now, the safe harbor itself is basically that organizations that reduced their FTE employees in the period from February 15th to April 26th and restored to June 30th have that automatic safe harbor. So that June 30th is like the magic date you want to pay attention to. And if you restore things to their pre-COVID or the start of the periods here, then you've got a safe harbor and you don't even have to go through the calculations. So obviously that's the ultimate situation here. I'd love to know, again, here, how much this applies to people. So Emily, would you please put up the 3rd poll? Did you experience a reduction of FTEs? So the first one is if you think you're going to be able to hit this where they're restored by June 30th.
Melody, one thing maybe you can address too while we're talking about FTEs is the difference between the number that was on the application itself, the original application when applying for the loan, versus the numbers that we're talking about here. There have been a few questions about the number that was put on the original application versus what they have to do for the FTE calculation.
You know what? I'll go and throw it right back to you because you did such a good job. I'm going to let you do it.
Sure. So I know I've seen a couple of questions here in the chat, so I figured it'd be a good opportunity to talk about it while we're talking about FTEs. So there was, excuse me, there on the original application when you applied for the loan, there was a question on that application asking for your number of employees at the time of the application. That question was not related to an FTE calculation at all. That question was strictly asking for your number of employees at the time, be it part-time, full-time, seasonal, looking for a 40-hour, 20-hour. It was strictly looking for your head count, essentially. I believe that this question, while it wasn't clearly defined anywhere, to be honest, this question was really to help the SBA and lenders determine that you actually were a small business by SBA standards, which means that you had to have 500 employees or less. So I just want to make sure that everybody's understanding that that number that you put on the original application didn't have anything to do with FTE counts. So what we're talking about now is related to how you will calculate forgiveness. So whatever you put on that original application, that doesn't really have any bearing on the numbers that you're going to put on this forgiveness application and the calculations that you're doing over these different periods of time.
Awesome, thank you. How do we do, Emily? Okay, so a little more than half don't have a reduction of FTEs. So for those of you that do have reduction, if at all possible, obviously the easiest scenario is to restore employment by June 30th, as that was the intent of the act all along, was to have that fulfillment. Now, I know there's been some questions and there's some seasonality to some businesses. One of the questions that came in regarding the hospitality industry and not being able to open the same way yet, that's where we're hoping that maybe there's this extension or a further time to restore based on some of that in the act that Kate mentioned. But as of this point, if that doesn't change, you would potentially have to go through the FTE calculations to determine the impact. All right, so once you've completed the worksheet, which was the listing of employees and their FTE and salary rates, to use if needed for the wage reduction and the FTE reduction, then we went to Schedule A, and Schedule A accumulated our payroll costs. And now we're going to go to the actual application. Itself. Now you'll notice that the introductory information is general information on who you are. But a couple of things I want to point out. Here's the piece that Kate was just talking about, this loan application, time of forgiveness, and time of loan application for employees. So that's different, as she's mentioned, than the FTE calculation for the reduction, potential reduction. The other thing I want to point out here is that the EIDL, if you did get in advance, it's required to be put here along with the application numbers. I'm going to let Kate jump in here. There's some clear indications when you were originally asked for this. If you got it in advance, it was going to be rolled into the PPP. I'm not so sure, Kate, if it was clear exactly how they're going to use this after. Is it?
It's not, no. You're referring to the advance amount or?
Correct.
The advance, yeah. So right now, the guidance, they didn't clarify too much, with the exception that on the forgiveness application itself, it does state that if applicable, SBA will deduct the EIDL advance amounts from the forgiveness amount remitted to the lender. So I would expect that if you received the EIDL grant, which was up to $10,000, you could have received anywhere from $1,000 to $10,000, that you will have to reduce the forgivable portion of your PPP loan by whatever that amount, whatever that grant amount is.
Awesome, thank you. Then obviously the next section here is what your schedule is for payroll. Now, remember that only weekly and bi-weekly are even eligible for the alternative period. If you pay twice a month or monthly, you're not eligible. And that's where hopefully that dates that we laid out earlier helps a little bit. And you'll notice that they want to know right up front whether you are one of those that they are going to look at your eligibility criteria. There was a lot of buzz when it came out that in the news about people applying for the loan that didn't really need it. And then people started to, be concerned of, well, I wasn't down to zero in my checking account. Am I still eligible? And if you're under 2 million, that's not going to be looked at by the SBA. And for the most part, we have said all along that, especially as nonprofits, there's so much uncertainty in how things are going to go forward that even if you have a little bit of reserves or other things right now, the uncertainty piece was still completely valid the way the certification statements were written. Then we get into the actual forgiveness calculations. So you'll notice that the payroll costs are the amounts from the Schedule A, which included the gross compensation and the employer healthcare, retirement, and state and local taxes. Then we're going to add in the mortgage interest payments, business rent, and business utility. Now, a couple of things on the all of these three is that they have to be based on agreements that were in place as of 2/15. Is that right, Kate? 2/15. So you can't have a brand new loan that would qualify here. It has to be a loan that was in position beforehand. The other thing, though, that was clarified, because there was questions about both the mortgage interest and the rent, if it was only for real property, it's now defined as for both real property and personal property. So both of those apply. The utility payments, I know there's still some questions around that. There is a list of what's included specifically in the application, but a couple that aren't necessarily as clear as they could be is water is included, but what about sewer? Because they're often on the same bill. It's not spelled out, but that one may be something that's clarified down the road. Transportation has not been defined, and I have yet to find somebody who has a good explanation for that one. So we don't know what's included in the transportation amount for those utility payments. In terms of reimbursements for employee amounts related to utilities, that also is not defined. It's clear that for the place of business, this is included, but not necessarily for amounts you might reimburse for internet or other services to an employee. So those hopefully will be clarified down the road, but that's the point where it is right now. I'm going to turn to a couple of questions that came in specifically around this. One of our attendees wrote in, the primary business for them is residential rentals, and are interested in utility expenses associated with the operations considered eligible expenses for calculating debt forgiveness. And I'm going to ask Kate's opinion before I give my own on that one.
Can you repeat the question, Melody? I'm sorry, I was answering a question in the Q&A.
Oh, sure. If our primary business is residential rentals, are interest utility expenses associated with those operations considered eligible for calculating debt forgiveness?
The interest and I'm sorry.
Interest and utility on rental.
Yes. Interest and utility on the rental units considered eligible. Is it being covered by the rent that somebody is paying to you for those rental properties?
That was my first question.
That would be my question. If it's being covered by the rent that you're collecting, no, I don't believe that it would be included. It's kind of one of those double dipping scenarios, but it also may be. I think that's a great question that I think we need some more guidance on. So.
I think, would you agree though, the mortgage interest, because they own the unit?
Yeah, yeah.
Eligible.
Yeah, definitely.
Yeah, the utilities would be the one I would question. So thank you. Another question that came in is cell phone costs. If you have a cell phone, a lot of organizations, that's their primary phone, that is eligible. But again, does it include employees? That part's not clear. And another question was about, what about internet platforms like Zoom or Crowdcast. It's not specifically spelled out, but my thinking on that would be that that's probably not, because it's not a utility, that's an application or a software application. So I don't think that qualifies. The one that a lot of people have also asked about is waste management, which is not specifically listed, but a lot of times we consider it utilities. So that one we do not have a solid answer on. Anything else there you want to add, Kate?
I don't think so. I think you covered it pretty well. I am seeing there's a question about a cleaning fee that is paid as part of the rent. Would that be considered a utility payment? As it's defined right now, I would say that that is not included. I have also seen a number of other questions about are the taxes included? So a lot of people will pay their rent, and they may have CAM charges included in there, so common area maintenance and real estate taxes. If those CAM charges are not defined in the utilities that we just defined, so electric, gas, water, telephone, internet, whatever transportation is, then it would not be eligible. Same goes with the real estate taxes. As far as the guidance is concerned, real estate taxes are not a part of the eligible non-payroll costs. It is strictly the rent that you pay for real estate and rent that you pay for personal property as well. So if you rent a printer or a scanner or something like that, that is also included.
Awesome, thank you. So then you'll see after we go down with all of the eligible costs, we now look at the potential reductions. And as we've talked about, the two potential reductions are the FTEs and salary. And in this case, there was no salary reduction in my example, and it sounds like most of you are not going to have to worry about that. But we did have an FTE reduction. So you'll notice that line 6 instructs us to add up everything up above, including the non-payroll costs, and then multiply it by the FTE reduction point to get down to line 13. I'm sorry, it's from line 13. The amount goes on to line 8. Reading too quickly there. So our potential forgiveness amount is $48,120 because of the reduction, even though our total costs were $52,000. Now in this last section, what's basically happening is they're calculating what's the maximum amount that you can actually have forgiven. And it's the one that is the smallest of line 8, 9, and 10. 8 is what we just calculated. 9 is the actual loan amount, which is on the spreadsheet example. And what 10 does is it takes the total of payroll costs that we calculated up above and does the math to say, okay, what would the total loan have been if exactly 75% of it was related to payroll, which in this case would have been a $66,000 loan. Obviously, in this case, the 48, our actual calculation is the smallest, so that's the amount that is eligible for forgiveness. Makes it all seem really easy, right? You're all ready to just jump into the great adventure? Question, Kate? You look like you had a question. You're muted.
I'm muted. I was just, there's a lot of questions about utilities. So I'm just trying to go through those and make sure we covered everything in our, in what we just talked about, so.
Now for nonprofits, you jump back in, Kate. Did you have something you wanted to add?
I don't think so. I think
Okay.
we're sorry.
That's okay. One of the other big questions for nonprofits is beyond the scope, honestly, of just this application and PPP. And that's the fact that a number of nonprofits have either federal grants, county grants, private grants that cover payroll. That is not a PPP issue. It's really more of a contract issue. You need to go back to the actual grant and look at how it's written and what flexibility you have in that grant. So for instance, some grants will allow you to change line items by 10%. So you could pull 10% of salary and put it in a different line item and then use part of the PPP for the wages. You really have to go back though to the individual agreements to see how this plays out. Just looking at a couple of questions here. If I had to prioritize, this question comes up too in terms of how would I use the funding? That's a really tough question because again, it would go back to the relationship with your grantors. Probably I would try to maximize the PPP if at all possible up front, and as much as possible within the grant, move things around so that I can maximize the grant funding, have conversations if applicable with the grantor, and at outset, you may just not use the whole grant, is kind of the scenario. The other scenario here then is what happens to the rest of this? In our example here, we had $64,500 that we received for our loan, but we're only going to be forgiven for $48,000. So what am I going to do with that difference? Well, you have a couple of options. You can obviously return the difference if you don't need it, or if you need it for cash flow and there's no reason that you can't use it for cash flow and for ongoing expenses beyond the 8-week period, you can keep it at that 1% loan amount and you have 2 years then to pay it off. So that is a viable option as well if you have funds left after the fact.
Melody, somebody is asking if you can clarify what you just said about taking out 10%.
What did I say about taking out 10%?
They said clarify what you just said about taking out 10%. Switching up grant funds.
Oh, I'm sorry. Now I know what they're talking about.
Okay.
Per line item within the grant. I'm just using that as an example. It's the most common one, but again, go back to your individual grant agreement. That it may allow you within the grant agreement to change the budget that was submitted and applied for that grant, to change line items by up to 10% of the grant amount. That's just one example. It depends on your particular grant. Thanks, Kate.
Great, thank you.
The other questions that come in is how does the PPP interact with the amounts and credits you might have gotten under the FFCRA? And I'm going to kick that one back to Kate too, because she did a really good job this morning. I'm going to let her explain how those interact.
Sure. So if you happen to be paying anybody right now under the Families First Coronavirus Response Act, includes some provisions for emergency sick leave and emergency paid family leave. You want to make sure that you are tracking that separately as a payroll item. If you use an outsourced payroll processor, hopefully you've been in contact with them to let them know that you are paying employees through the FFCRA, because you get dollar for dollar credits for paying people under that the FFCRA. And you cannot use PPP funds to cover those wages because you're already getting a credit for them. So you just want to make sure that in your payroll system, if you're doing it yourself, you make sure that you set up another payroll item. So you probably have a payroll item for salary, maybe vacation pay, holiday pay, sick pay. You want to make sure you have another payroll item set up called FFCRA pay, or something like that. That seems like it would be the easiest, so that you're tracking it separately, because you are going to need to be able to split out the wages paid under excuse me, FFCRA, because they will not be covered by the PPP funds. So it could potentially impact the first portion of your PPP loan, but the likelihood is that you won't actually be able to use all of the loan anyway. So you'll have that money left over to be able to pay back, continue to use afterwards. But just make sure that you're tracking it separately, because you can't, once again, we have to avoid double dipping in any way, shape, or form. So.
And that's a good point, what we were talking about earlier with the EIDL and the advance. We're not it's not clear if you didn't receive the advance up front, how they're going to treat it. But you can't use EIDL and PPP again for the same expenses either, just like the grant situation we were just talking about. The key is you can't use two sources for the same expenses, obviously. So the second page of the application is the certifications. And just like in the application for the loan itself, you're going to need an authorized representative to sign this. And that's generally somebody on the board potentially for not-for-profits. Most of the certification is basically attesting to the fact that you completed it with truth and full disclosure, and that you did it according to the instructions. So obviously it's important to read through these as well, and noting anything that is said in the clarifications. Now I want to go forward to one of the last pages on the documents. As Kate and I have been saying, we wouldn't encourage you to jump into any calculations yet because it's premature and you may be doing work you don't have to, but you should be considering, like we've said all along, how you're documenting it and making sure that you have the things in place. So I would recommend going through this especially and making sure that you have the information, or that you get it set up that you will have the information when you submit. There's certain things that have to be submitted, as you notice in this top part, and there's other things that have to just be maintained and could be subject to remission later or clarification kind of issues. So there's two buckets that you're looking at. The other thing I would highly encourage at this point that you can do is talking to your payroll provider, if applicable, that what pieces of this can they give to you. Some of them may be able to give you for certain periods that those FTEs or other things. So see what the payroll provider is able to give you. In terms of the documentation at a high level, what you'll notice is that it's looking for documentation of the expense, but also, as you'll note here and see, the payments. So throughout, they're looking for a valid expense referenced by some kind of document, but they're also looking for the actual disbursement of the cash. So in this case, a bank statement, it says, or a payroll service that documents the amount of actual cash compensation paid to employees, as well as canceled checks as applicable kind of situation. They're looking to those official payroll kind of forms that you file with the IRS, typically, like it says here, the 941. Documents showing the FTE, if applicable. Actually, that's a good question as I'm reading this. I'm assuming, Kate, tell me what your thought is, that they don't have to submit all this documentation if the safe harbor applies.
I would expect that they wouldn't have to, because if they've stated the case that they have met the safe harbor, or if they stated that they didn't have any reductions in FTE, the instructions state to skip certain steps of calculations. So I would expect that you don't need to do the work if you genuinely didn't, if you genuinely don't need to. So if you really didn't have any reduction in number of employees or FTEs, and you didn't have any reductions in wages, then you shouldn't also need necessarily the backup calculations to prove that, because the instructions clearly state to skip the steps where you make those calculations. So.
And I think they've definitely incentivized it to restore those FTEs if at all possible, because look at the amount of documentation you have to have for each of these if you have to go through the calculations as well. And then the non-payroll documentation to verify the existence of the services as of or prior to February 15th, and then the corresponding documents that show the valid expenditure. The documents you're not required to are basically the things that went into your Schedule A worksheet. But again, you want to make sure that you keep this all well organized and documented, so that if there are questions that you're prepared and you can answer the questions. As I said at the onset, You're going to submit the documents to the lender, or if the lender has serviced it, they'll tell you who you have to submit it to. But the review of the application itself will be done by the SBA. So that's why it's important to keep all this documentation, even those that are not required to be submitted. And then just as we mentioned at the outset, there is an optional demographic piece, but this really is not as applicable to nonprofits, although it does have the officers and directors. It's up to you on whether you want to complete that. So we still have plenty of time if there's questions, and I'm going to kick it back to Kate to kind of tell us where we're at.
Yep. We definitely do have some questions. I've been trying to answer the ones in the chat, since I know those won't carry over as quickly as possible. Some of the questions that have come in are related to the payroll period, so we may want to talk a little bit about that again. We have, let's see here. I think maybe I'm seeing a lot of questions just about the eligible costs themselves. So it may be great if we could kind of just re-review what eligible payroll costs are. Getting some questions about the insurance costs less the employee paid share. Will cash, is it include, does the cash compensation include fringe benefits? What about state unemployment as it included employer payroll costs? And maybe if we just want to go back through what those eligible payroll costs are so people have a clear understanding.
Sure. Gross compensation includes cash compensation as defined here. It's the sum of gross salary, wages, tips, commissions, and paid leave other than, like we said, the family first paid leave, and allowances for if you have to let somebody go during this period. That's all included in the cash compensation. The other piece that we mentioned earlier was potentially bonuses or hazard pay, and that does not have clear guidance. And my one word of thought would be make sure that you can have a strong rationale and documentation for it, because there is the possibility that they're looking for abuses where you're putting out bonuses just to use up your forgivable amounts. The other payroll costs that are included, I don't know if I have them listed somewhere. Is it listed in here at all?
It is listed in the application.
Here we go. Employer contributions for employee health insurance, including contributions to a self-insured employer plan, and total amount of employee retirement, excluding the employee portion. So remember, these are for employer payment portion, not what the employee is kicking in, and state or local taxes. Depends on if your state even has unemployment for not-for-profit. I'm sorry, yes, unemployment for not-for-profit taxes, whether that applies or not. It's only state and local. There are some local municipalities that will have additional insurance, but there are no federal amounts that are included there. How else what else did you say, Kate? I'm sorry, I may have.
So just in relation to some of those questions, what about employer paid HRA? So health reimbursement arrangements, are those included?
My understanding that hasn't been defined. Do you have a better answer?
I agree with that. I expect that because they are covering employer paid health insurance that will be covered, but it has not been clearly defined. Same with dental and vision insurance. I know we talked a little bit, you talked about that earlier, but I do see a couple of questions asking about that again. So not clearly defined yet. Again, we expect, if you've been keeping up with the Treasury frequently asked questions document, which we have a live link to that document in our Wegner CPA's Resource Center. You can get to it from our page, or if you just type in Treasury PPP FAQ, you can find it. It'll tell you the last date that it was updated in the upper left-hand corner. It's a great resource. but that document is a live document and they update it as soon as they have more information. And like I mentioned at the beginning, on the webcast that I just sat on right before this webinar, they expect to see an additional 20 to 25 new frequently asked questions added. They were hoping today, but they expect that no later than tomorrow we should see that. So hopefully a number of these questions that you guys are asking today, everybody's asking these questions, so it's great. That means they're listening, and hopefully we'll see answers by tomorrow on some of those. So Melody, maybe you have a bit of experience with a 457F plan. I don't have much experience with those. I'm seeing that that's a non-qualified deferred comp arrangement.
And the last I've heard on that, that one also is not defined, and is the 403Bs and the 401Ks are definitely included, but there's questions on that one.
Okay. Let's see what else here. Oh, I just shrunk my screen down.
Just as Kate was mentioning, here's links at the end of this, and you'll get the slides like we talked about and the examples, the handouts and examples. But the different resources available on our site, as well as what we mentioned of the AICPA has some resources and a calculator if you're interested in that. I don't have on here the Treasury one that Kate mentioned.
We can try to send that out with the, well, I recommend going to our Wegner CPA's resource page to find it, or a quick Google search will find it as well.
Yeah.
So I'll go through a couple of these questions that are in the chat so we can answer them right now. Do non-payroll costs need to be prorated to the exact 56-day period as well?
That's like the
$1 million question.
Yeah. Because they're not always in the exact same time frame, it's not clear from my understanding. What's your take on it?
I would agree with that. I think there are certain things, I answered a few questions in the chat about health insurance. So for most people, they're paying monthly, maybe their payroll is biweekly. How do you get an accurate representation of what the employer portion covered eligible payroll cost should be? In a situation like that, I would recommend likely annualizing your costs so that you can break it down to that 8-week covered period. But for something like rent and utilities, I think the intent is that you're not really going to need to prorate that for 8 weeks. You're likely going to have 2 months worth of utilities and 2 months worth of rent, because you're going to have a receipt. They want to see backup documentation for those payments. So to have the added burden of doing a prorated calculation of what the 8 weeks covered, I think that's unreasonable. I don't think that's the expectation. So the likelihood is non-payroll costs, you're going to be looking at 2 months worth of those costs.
I completely agree. And you'll notice in the instructions, it says with the utility costs and some of those other costs, that again, to be included, just like the payroll, you can make payment on the next due date, even if it's outside the 8-week period, and it's still an eligible cost.
I see a question in here about a minimum pension obligation that's paid quarterly. Do you know anything about that, Melody? Have you seen the question at all before?
No, I haven't. The pension question is interesting though, because I was on a call right before this asking about the employee makes annual contributions to the plan the way they're set up. And so they just made their 2019, and how are they going to have anything for this? It's a good question. I don't have an answer on that one.
Yeah, I have talked with a couple of clients that similarly may choose to make their, if they contribute 3% to all of their employees, maybe they only do that once at the end of the year. Or they make, if you have a set plan that is totally at the discretion of the employer, but you still intend to do it, you did it last year, I recommend that you should try to prorate. Again, for the payroll costs, you can really break it down to an 8-week period, and I think that those costs should still be eligible, but you are going to have to do a little bit of math to get it down to what that cost would be for the 8-week period. So certainly likely worth doing that math if you're making substantial contributions to your employers in your employees' retirement plans.
Completely agree. Other questions?
There's a question going back to the FTEs. There are some questions looking for a little bit more clarification and guidance on what safe harbor means, what it is. So maybe we could go, since we've got a little bit of time left, maybe we could just go back to the safe harbor and talk a little bit more about that.
Sure. There's two different things, okay? There's this reduction relief that applies just to specific employees, so you can put a 1 instead of a 0. But then the safe harbor itself is meeting both of these criteria, so that in essence, if you've met the criteria and restored employee levels to that June 30th date that you had pre-covered period or pre-February, you're back to the same FTEs, then you've qualified for the safe harbor. And if you recall, when we looked at the application, you can just put a 1 in if that applies. So you don't have to go through the other calculations. You will have to though show, like we said, the FTE, part of this, you cannot avoid having to do the calculations because you still do have to prove, even for the safe harbor, that what you had February 15th through, February 15th through the April period, that you have to have that calculation to compare it to the June level. So.
All right. Where in the payroll calculations do you show the percentage of an employee's pay that may be covered by a grant when there's no flexibility with the grantor to use the grant funds for something other than personnel?
If you're allocating it between PPP and a grant, I guess what I would suggest is you take that payroll report, do the schedule or report with that shows how you're allocating it. But in terms of what you put on schedule or the worksheet for Schedule A, I would say that you're only putting in the amount that you're wanting for PPP, unless you disagree, Kate. What's your thought?
It depends on whether or not you, there was a reduction in their salary, I'd say, because and not get you don't want to get dinged for reducing somebody's salary. I honestly think because they open this up to nonprofits, I'm sure that they've heard a lot, the SBA and the Treasury has heard a lot about questions exactly like this. What do we do if we have grants that are covering salary costs? So there's going to have to be some sort of nonprofit centric version of this that's going to cover some of these things once the final guidance comes out. I think I agree with Melody. If you didn't have any wage reductions at all and you can do the calculations based on taking those payroll funds out in your comparisons, then yes. But if you did have wage reductions, I think you may have to have an addendum to the addendum spreadsheet. I think you're have to do a little bit of extra legwork, unfortunately.
But that would all be documentation that you can retain if there's it's not documentation that you have to submit.
Right.
So.
Let's see. So we've got in retirement benefits, and I'm gonna open the question up a little bit to include, can any of the eligible costs be prepaid for the remainder of the year? I can answer that one pretty easily. No, there are no prepayments allowed. Those are not eligible costs. That goes not only for the retirement benefits, but it also includes utilities, rent, or your health insurance premiums. Again, we're talking about this 8-week covered period, costs incurred and paid. So the prepayment of your retirement benefits would not be a cost incurred in that 8-week period. That also answers a question too here. I see in the Q&A, there was a question question earlier about back pay. Is back pay an eligible cost? That is not an eligible cost at this point. So if you had laid off workers prior to receiving the PPP funds and now you've hired them back, you cannot use the PPP funds to pay them for the, we'll call it the lost wages from the time period that you had laid them off. Again, this is intended to be the costs incurred in this covered period. Let's see. So another question about the EIDL and PPP. There is a question about, are we required to pay back the EIDL if they got it before the PPP funds, or can the EIDL funds used to cover equipment expenses, computers, phone services, internet expenses? I know Melody talked about this a little bit earlier, and there is, I think we are still awaiting some clarification on the use of EIDL, the EIDL grant money as it relates to the PPP funds. I think because it's being rolled in with your PPP funds, the likelihood is you may have already used it for some of the expenses that you are now using the PPP funds to cover. So that's why they're rolling that grant money into the loan forgiveness calculation, because the assumption is that you may have already used it to cover payroll or to cover rent, to cover utilities, as those are likely your most common ongoing expenses. If you if you use it for something else, like equipment expenses, like to purchase equipment, there isn't anything that says you can't do that. So at this point, I would say anything related to the EIDL, whether you received the loan, or you just received the grant, those funds are eligible to be used for anything that's not PPP related. So I would say yes, that it can be used to cover other things.
And as long as we're talking about EIDL and PPP, it brings me back to something I meant to mention earlier. It has been decided that PPP funds are not federal funds in terms of single audit kind of situation, but EIDL is. So that's another issue to be aware of from perspective of audit circumstances, not necessarily application and forgiveness piece.
Yeah, that's huge. That is huge. And that, I just to expand on that a little bit, it has to do with the fact that the EIDL is coming directly from the SBA. So you're working directly with the SBA, who is a federal lender, as opposed to with the PPP, where you're working directly with a bank. So even though it is federally backed, you're not working directly with the lender. So that's a positive, I think. There's a question about paying rent late. So actually 3 months in the 8-week period will be paid. Is that okay? And they have documentation. I would say that that's not going to cut it. That's kind of similar to the back pay question. And we want to be thinking about costs incurred in the covered period. So costs incurred means you had like 2 months worth of rent, and you're paying 2 months worth of rent in that covered period. So I would say that 2 months is what you're going to be able to cover.
In general, just to summarize that, I think that the only difference between payroll and non-payroll costs in terms of incurred and paid is payroll, they've made it very clear, has to be limited to 56 days, where the others, as Kate mentioned earlier, 2 months is fine. They're not going to ask you to prorate the few days different.
Yeah, I think the difference really comes from the fact that you can run a payroll report essentially for any period of time. So it should be pretty straightforward, whether you work with an outsourced payroll provider or you process payroll internally. You're going to be able to pretty easily be able to run a payroll for any period of time, regardless of when your payroll periods actually are. So I think that's kind of the big difference when thinking about the payroll versus the non-payroll costs. Let's see, other questions. Would a one-time payout for earned PTO be eligible for PPP?
employee leaving.
Yeah. Yeah, I mean, if it's considered severance, then yes, it is.
Yeah.
If
I
they,
also had a question come up the other day about that in regards to maternity leave, and that's totally eligible then.
yeah. Yep, I mean, I think if they took PTO and you're paying them for that, that is an eligible cost. If you're just paying them one time for PTO to get them more money, I think the payroll, I think you may see some issues there. So be careful with that. Let's see. Could you include wages to bring staff back to full pay if the wage reduction took place prior to the PPP covered period? Absolutely. Yep. I mean, the encouragement of the Paycheck Protection Program was to get people rehired and back to their full wage if possible. The reason being that you got 2.5 months or 2.5 times your average salary for your loan. So ideally, if you don't have any other non-payroll costs, or even if you do have if you have other non-payroll costs, the idea would be to try and bring people's salaries back up to what they were, we'll call it pre-pandemic. So
what's interesting that the application for the actual loan took 2 months of salary times 2.5, and yet the forgiveness is based on 56 days, and you may not have that 0.5 extra of additional costs. So it's not unusual to find that you actually have more funds than you are eligible to submit for forgiveness. But like we said earlier, then you can either refund or pay back the amounts because there's no prepayment penalty, or you can use it at the 1% interest.
I do see a question about lease payments on personal property. Can they be included, like copy machine leases? And the answer is yes. So that was one of the items that was clarified in the forgiveness application. Lease payments and interest on mortgage obligations both include real estate and personal property. So the answer to that would be yes. And then just related to what Melody was just talking about, must the unforgiven part of the loan be limited in use to payroll, rent, and utilities until it is paid back? My best advice is yes. When you made a certification on the original SBA loan application that you were taking this loan out to use for the eligible costs that had been defined. I've seen a lot of questions as to whether, if you don't end up being able to use all of the funds in this 8-week period, then it just turns into a loan that you can use for anything. I would highly advise against that. And it's just simply going back to the original the PPP application when you applied for the loan. There is a very specific certification that you signed off on that if you don't use the loan for the purposes it was intended for, that the government can charge you with fraud. So I would not recommend using it for anything besides the eligible payroll and non-payroll costs, even if you aren't able to use it in that 8-week period.
And I agree with that. And I think that clearly is the distinction between the EIDL and PPP. I mean, they were intended for separate segments, and this was very strictly intended for those limited expenditures.
Yeah. I think for the most part that addresses the bigger questions in the chat. I know we have a lot of questions in the Q&A, but I wanted to make sure that we got to those chat questions before our time is up. So Emily, I'm guessing you probably want to remind everybody to throw things back in the Q&A if they want.
Yeah, so our lovely presenters will be following up with everybody who submitted a question in the Q&A. So if we didn't get to yours today, please make sure to include that in the Q&A and we will get back to you as soon as we can. Ladies, do you have any last minute things to add before we wrap up for today?
I know this seems daunting, but the positive part and the part we want to say congratulations on is you got the funding, and that may continue and allow you to sustainable. So celebrate that part and we'll work through this other adventure together and we'll still be here. So if you have questions, feel free to reach out.
Yes.
And I would just remind everybody that there is still money available. Again, the webcast that I just sat on as of 5 p.m. yesterday, there's still about $140 billion out there. So if you're sitting on this webinar, or maybe you're part of another organization that hasn't applied because they weren't sure if it was the right thing to do, if you're struggling and you need some additional help, make sure that you're looking to the banks because there's still money left and it's there for people to utilize. Right now, the applications are open until June 30th or, until the money runs out. So right now, there's still money left. So I would say go ahead and apply if you haven't already and you need it.
Excellent.
Awesome. Thank you. Well, thank you all for joining us today. Please keep your eyes open for our emails and visit our website for upcoming webinars. We are trying to inform you just as fast as we are being informed on the changes of everything going on. So thank you all for spending time with us today, and I hope you have a wonderful rest of your day. Thank you, ladies, so much.
Thanks.